This is the final episode, selling or closing a company without falling for tax myths. The biggest tax mistakes often happen when business owners sell, close down, or leave the company. We will look at 3: termination payments, business asset disposal relief, and long-term exit planning. It also connects these decisions to the salary, share, and profit planning choices covered earlier in the series. One common claim is that a director can pay themselves £30,000 tax-free when closing a company. That is not a general extraction allowance. The first combined £30,000 of certain genuine termination or severance payments may be free of income tax. But normal salary, bonuses, holiday pay, and payment in lieu of notice remain taxable earnings. The post-employment notice pay rules can also treat part of an apparent severance payment as ordinary pay. For an owner-director, HMRC can examine whether the payment is genuinely compensation for losing an office or employment, or whether it is simply a distribution of company funds dressed up as compensation. The commercial reason, employment history, contract, board process, and calculation all matter. Amounts above £30,000 are subject to income tax, and the employer pays Class 1A national insurance on the excess at the current 15% rate. The safer message is this: a qualifying termination payment may be available in a genuine termination, but it should never be treated as an automatic final withdrawal strategy. From the 6th of April 2026, qualifying gains are taxed at 18%. The old 14% figure only applied to qualifying disposals made between the 6th of April 2025 and the 5th of April 2026. For shares in a non-EMI company, the conditions normally need to be satisfied for at least 2 years before the sale. You must be an employee or office holder. The company must be a trading company or the holding company of a trading group, and it must be your personal company. That usually means holding at least 5% of the ordinary share capital and voting rights, plus an entitlement to at least 5% of distributable profits and assets on a winding up, or at least 5% of sale proceeds. The detailed tests really matter, especially where alphabet shares, growth shares, or investors have changed the rights. BADR has a £1 million lifetime limit per individual. The original claim that this automatically creates a £100,000 saving is now wrong. If the comparison is with the 24% higher capital gains tax rate, the maximum rate difference is 6 percentage points, equal to £60,000 on a £1 million qualifying gain. The real saving depends on the gain, the normal rate that would otherwise apply, and how much of the lifetime limit has already been used. A spouse or civil partner can have their own £1 million lifetime limit, but only if they independently own qualifying shares and meet the employment, ownership, and 2-year conditions. Transferring shares shortly before a sale will not normally create immediate eligibility for business asset disposal relief. The share rights discussed in Episode 3 can affect BADR. The dividend decisions in Episode 2 affect how much cash remains in the company. Pension contributions may reduce profit before an exit, while poorly documented termination payments can create an avoidable tax dispute. Good exit planning starts at least 2 years before a likely sale, not 2 weeks before completion. Review the share structure, trading status, employment position, company investments, and previous BADR claims early enough to fix problems properly. Across this series, the repeated principle has been the same. Tax efficiency comes from matching the legal documents, accounting records, and real commercial activity. Use the reliefs that apply, but never force a transaction into a rule it was not designed to meet. Start exit planning early with ABC Business Services before agreeing a sale or closure. You can speak directly with a member of our team, email us to arrange an appointment, or visit our website for more information.